Hi, good evening, everyone. Thank you for joining in the call. So today we have a call on the monetary policy update. On the call, we have Mr. Paijat Agarwal, head fixed income for us. We also have on the call Devesh and Anjul, a part of the fixed income team. Without taking much time, over to you, Paijat, to give us an update on the monetary policy.
Thank you, Saurav, and warm welcome to all our viewers and listeners. So, much anticipated today's monetary policy outcome. So, I'll share the PPT. Yeah. So, hold on. Yes. So, as anticipated, the repo rate remains unchanged at 6.5%, and consequently, the STF rate, which is standing deposit facility rate, remains at 6.25%. And MSF, which is the marginal standing facility rate and bank rate, remains at 6.75%. This decision to keep the policy rate unchanged was unanimous. All the six MPC members voted to keep the rates unchanged. The stance, the MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Now, this stance was anticipated, and this was 5:1. Five members voted to keep the stance same, accommodation withdrawal of accommodation. One member voted against for that. Now, what were the reasons behind keeping the policy rates unchanged, and what forecasts were there for forthcoming, GDP growth and the inflation, or what was the points which made the MPC to keep the policy rates unchanged? First, let's look at the GDP growth projections. In this policy, the MPC has maintained or kept the full year real GDP growth at 6.5%. It was same at 6.5% in the last policy also. In fact, if you look through the numbers, the quarter-wise numbers for the first quarter, second quarter, third quarter, and the fourth quarter of FY24 has remained same as of the last policy. Now, what were the pointers which kept the growth resilient or at the same level at 6.5%? See, the momentum of overall economic activity has continued to be positive. It has remained robust. So, on the three parts, first is the supply side. So, on the supply side, the crop sowing has picked up. Industrial activity is holding up, and it is evident in the various data points like your IIP numbers, the PMI for manufacturing, PMI of services numbers, core industries output, and all the high frequency leading indicator data points towards a momentum in economic in the supply side projections. In terms of the aggregate demand conditions are buoyant. Both the urban and rural demands have picked up and has remained robust. This is also evident from the high frequency leading indicator numbers. If you look at the investment activity, so the investment activity, gained further momentum at the back of the, government's push to the capex, and also the private capex has picked up in certain sectors, not across, but yes, in certain sectors. The important point to understand here is that, or to note is that the capacity utilization is running at 76.3%, which is has above the long-term average of 73.7. So, which clearly shows that economic activity across has picked up, investment activity has picked up, consumption has remained robust. So all these factors put together tells us that the real GDP growth is expected to be 6.5% or slightly better for the full financial year FY24. Now, if we move towards the factors which I just mentioned that which supported growth. As I mentioned, India's services PMI came at 13-year high at 62.3 in July. It was 58.5 in June and 61.2 in May. Healthy expansion in e-way bills, toll collections, railway freight, which points towards a healthy growth in the economy. As I mentioned, the urban demand has remained buoyant with various high frequency leading indicators showing that domestic air passenger traffic, passenger vehicle sales. Recovery in rural demand, as I mentioned, there has been a high growth in agricultural credit and improving sales volume of major FMCG companies across the rural landscape. There has been revival in capex, metals, petroleum, automobile, chemicals, iron, steel, cement, and food and beverages are the certain sectors where we have seen private capex picking up. Healthy growth in cement production and steel consumption. And as I mentioned, the capacity utilization is at 76.3%, and it has remained above the long-term average. Upcoming festival season is expected to provide support to private consumption and investment activity further. Now, what are the risks to the projections or the data point which has come so far? It can be because of the weak external growth momentums, because we have noted that the growth has been slower in number of advanced economies, particularly China and the Europe. So that can be factored that it can put pressure going forward on the domestic growth numbers. Volatility in financial market, that puts pressure. Protracted geopolitical tensions can disrupt our projections of the growth. And definitely monsoon projections, the El Nino impact, if it continues to prolong for longer or it takes a different turn, which is very difficult to project. So if these things pan out, yes, there could be downward risk to our 6.5% projections for the growth for the full year. The CPI inflation, which had remained at 4.8% in June, has actually accelerated to expected to accelerate to 6.5% in this month of July. This has been because of the, as we are all aware, the extreme hike in the various food prices, and particularly in the vegetable prices. So looking at the various data points for the inflation, the RBI has hiked the full year projection by 30 basis points from 5.1% to 5.4%. And if you look at the various quarters, in fact, that has also changed. So for the second quarter, they have increased by 100 basis points, almost from 5.2 to 6.2%. For the third quarter, from 5.4 to 5.7. Fourth quarter, from 5.2, it has remained 5.2. And for the full year, has been increased by 30 basis points from 5.1 to 5.4%. And for the first quarter, FY25, it is projected at 5.2%. Now, what are the various factors which took that inflation higher or the spike in the near-term inflation? In terms of the MPC members, this is not a very protracted or longer-term increase in headline inflation. It appears to be a spike in the near-term inflation. So after reaching a low of 4.3 in May, it rose to 4.81 in June, and is expected to surge during this. The poll is at 6.43%, and it was largely led by vegetable prices that we are all aware. Now, the crude oil prices have firmed up in recent weeks, and its outlook is clouded by demand-supply uncertainties. The self-imposed production cut by Saudi Arabia of by more than $1 million barrels has actually pushed up the crude prices upwards, and it is hovering near around $87 to $88 a barrel. RBI's projection for the full year is at $85 a barrel. So we are not, far away, or the RBI's projections are much lower than the actual prices. So it's in line with that. Global food prices are also exhibiting a hardening bias on renewed geopolitical tensions, as we have seen that the attack on the Ukraine, from where they had been exporting grains, or the pressure on the Russia to export grains has put pressure on the global food prices. However, this has the inflation so far, that spike in the inflation, what we have seen, has been limited to the food part of that. The food inflation has remained extremely volatile and on with the upward bias. But the positive side is that inflation, excluding food and fuel, has softened by more than 100 basis points from its recent peak in January 2023. And what we understand is that despite the inflation, going beyond the RBI's upper band of 6% to closer to around 6.43 for the July, the MPC decided to stay put or not hike the rates. One factor was that this unseen or unknown food price hike is seen to be as transitory, and it is expected that the vegetable prices and the other food prices would start to come down in a 2 to 3 months time. And the core inflation has remained benign and is on a downwards trend. So that's one reason why we believe that the MPC decided to stay or keep the monetary or the repo rate at 6.5%. They would like to see more data points before taking a further call. One important point here is that the MPC members also highlighted that although they have kept the policy rate at 6.5 and they have overlooked the recent spike in inflation because of the food articles, but it doesn't mean that they are going to be easy to keep track of the inflation. In fact, the MPC is maintaining that they want the inflation to come back to 4%, and if warranted, and if this food prices or the food inflation continues to get entrenched in a larger picture of inflation, they may use various tools to keep a check on the policy and keep the check on the inflation. So it could be either by managing liquidity or it can be by raising the rates going forward. Now, what are the various key risks that can keep the inflation upwards? It is the special and temporal distribution of monsoon, the El Nino impact that could impact further the food inflation. There could be supply side shocks, the global commodity and food price outlook, as I mentioned earlier, that food prices have firmed up in recent weeks. Even the global commodity prices have inched up after founding a base. In fact, we have seen that the crude prices have moved up to almost $88 a barrel. Sustained increase in domestic food prices, if it continues for more 3 to 4 months, it gets entrenched, and the core inflation gets entrenched and gets very sticky, and it becomes very durable. So these are the factors which kept the MPC, or MPC decided to keep the policy rates unchanged. In terms of the liquidity, the daily absorption of liquidity under LAP, that is average around 1.8 lakh crore during June, July, as compared with 1.7 lakh crore in April to May. Foreign exchange reserves stood at a comfortable level of 601.5 billion as on August 4. Now, in order to withdraw the liquidity, because RBI stance is withdrawal of accommodation. So obviously the liquidity has remained very, very sufficient in the system, and in fact close to 2 to 3 lakh crore. As it impacts their inflation targeting mechanism, the excess liquidity impacts the inflation. So in order to manage that, the RBI has introduced a new measure to manage this liquidity. So with effect from the fortnight beginning August 12, scheduled banks shall maintain an incremental CRR of 10%. Incremental, please note, it is incremental CRR of 10% on increase in the NDTL between May 19 to July 28. So during this period, whatever has been the increase in the NDTL, so the RBI has asked the scheduled banks to keep additional 10% CRR on this. This is a temporary measure for managing the liquidity overhang, and this decision will be reviewed on September 8th or earlier as warranted. So please note that the actual CRR remains at 4.5%. This 10% is only for this period, and whether it would be continued or it would be reversed depends upon decision when the RBI meets on 8th of September or earlier than that. So even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. As per our calculation, this additional 10% CRR on the increased in the NDTL between May 19 and July 28 comes to somewhere around 1 lakh crore. So that kind of money would move from the system in the CRR. If you look at the credit and deposit growth, as per the chart, you will see that both the credit and deposit growth numbers look very, very elevated. But please note that it is because of the HDFC Bank and HDFC merger. Excluding the impact of merger, credit growth and deposit growth would have been at 14.4 and 12.3%. So obviously from the peak of 17.9, the credit has started to trend downwards at 14.4, and the deposit growth has held up. So credit growth is at multi-year highs on the back of economic expansion, increased capital expenditure, and implementation of PLI schemes and a push for retail credit. The growth in recent months has moderated slightly as compared to previous few months. The credit growth was led largely by higher personal loan demand and an increase in lending to NBFC segment. Now, if you put all these points together, what is there for the fixed income markets or the rate markets looking forward, or for any investor who is looking to invest in any fixed income funds? The real policy rate continues to be positive. So repo rate at 6.5, projected inflation is at 5.4%. So obviously you have a positive real rate. Global central banks have put a pause on rate hikes or around their last leg of rate hikes. Some banks, central banks increased again after, doing a pause on the rate hikes, but again have gone back to pause. That's what we have seen in the Reserve Bank of Australia and certain other banks. In fact, in the US Fed also, they went on pause and then again did one rate hike last month. And it is expected that this could be their last hike, what they had done in the month of July. RBI, to ensure adequate liquidity for productive requirements, and our forex position or external sector is extremely comfortable. India's external debt ratios are low by international standards, and the external sector remains very resilient. The domestic inflation, going by past trends, is expected to fall towards the RBI's projection. The spike in the food inflation that we have seen is expected to fall within between 2 to 3 months' time, and there will be correction on that. Given the likely short-term nature of these shocks, monetary policy can look through high inflation prints caused by such shocks for some time. But obviously, if it remains elevated for a longer period, then yes, one can expect one more rate hike. The geopolitical risk, global inflation trajectory, sustained increase in domestic food prices, and uncertainties around monsoon remain the key risk to all our projections. Now, markets are expected to remain volatile in near term because, as we have seen, that markets have continued to, they have continued to look to the near term with whatever the data points are coming. So, and the near term data points has remained extremely volatile. Sometimes they are benign, sometimes they are adverse. So the markets have continued to react to that. Absolute yield levels are still attractive from a medium to long-term investment horizon. To give a perspective, the 10-year is at around 7.17. Your AAA-rated corporate bonds of PSU AAA-rated corporate bonds are at around 7.5 to 7.60 for 3 to 5 years. So it remains extremely attractive. So as I mentioned, the upward revision in inflation by 30 basis points actually rules out any rate cut for this financial year, but one can expect going in the next financial year. So as and when the inflation starts to trend downwards, what we have seen towards the 4% mark, then we can expect some M2M gains to accrue as well. So from a total holding return could be very, very attractive. You have your 7.5% accrual plus M2M gains. That is very, very attractive from medium to long term perspective. So that's all in a nutshell on today's MPC outcome and going forward how the bond markets look.
Thank you, Parijat. Can we take questions now, Parijat?
Yes.
Okay, the first question is on the NDTL.
Yeah.
So during the press conference, RBI governor said approximately outflow of 95,000 crores to 1 trillion can be seen. Right?
Yeah.
The question is how is this calculated? Because one assumed that the major incremental NDTL is due to 2,000 rupees note deposits, right? And then 10% of that could be very low, which is 27,000 crores.
See,
the calculation doesn't add up, which is a question.
I'll explain. See, what is there is that, so it is not only the 2,000 rupee note. So what the RBI governor and deputy governor explained what they said that it is a total liquidity hang which they have seen. They are not looking only at, so a large chunk may have come from, some money must have come because of 2,000 rupee note. Some is because of the merger of HDFC and HDFC Bank and other factors put together. So they are looking at a number which they believe they need to take out from the system. So that's the number which they have taken, 1 lakh crore, which comes to somewhere around 10% of the NDTL, which they have calculated. So they have already done these numbers before. So it is a sum, it is a, all put together, this number is coming. It is not only one part of 2,000 rupees.
Okay, thanks. The second question is, Parijat, that on the food inflation, isn't it true that the interest rate hike can take care of demand side inflation, not supply side inflation? And most of the food inflation which is coming in right now is because of supply side issue. So how does increasing the rate will help curtail the food inflation?
See, this is very true that supply side inflation cannot be controlled by the increase in rates. But let's note that when the food inflation remains elevated, it starts to getting interest in the other parts of the economy. So it gets into the wages. So and then the other factor starts to get in. So obviously one has to work on both the ends. First, we have to take care of the supply side also, which is very, very important, and also make sure that the expectations don't get entrenched. So that's why you do the rate hike.
Okay. What's your expectation on the cutoff for the new 10-year, which is going to come in?
See, this time, normally what happens whenever there is a new 10-year, the cutoff is generally 3 to 4 basis lower than the existing 10-year. Now, looking at the mood as of now, which is in the near term, not very bullish. I'm talking about the near term, not the longer term. Near term, it is not very bullish. So expectation is around the same level as which is the old 10-year. So somewhere around, I would say 7.17, around that level.
Thanks. While you have said that the chances of a rate cut happening in this financial year is very, very low, are you seeing it happening in Q1 of next financial year?
As of the data points which are there, yes, it is possible. But we need to look much more data points to be very, very sure. But the possibility of rate cut opens up in first quarter next financial year.
And is it also true that the India will wait for US to start cutting down rates before they actually cut down rates, or they can do it before?
I would say that our own MPC would remain, will hold on till the US Fed gives a signal by cutting rates there. So that is true because any rate cut by us and not by others, actually would put pressure on the INR. So obviously that's a factor there. So we will wait for the US Fed to take some action on the rate cuts before we actually do that.
Yeah. So there's a chance that there will be a synchronized rate cut across the world
Yes,
like it was the other way around.
very true.
Okay.
They all move together.
Uh, in terms of duration, what is your expectation on the long-term fund? You're looking to keep duration high, or you're looking to actively manage them
See,
in the
looking at the various data points on the inflation and growth, the near term can remain extremely volatile. So, as we have seen, the market reacts to various data points which keep coming in. So sometimes these are against our position, sometimes they are in our favor of our position. So what we realize is that the best way to play the market today and not get caught up in this volatility is to buy long, that is add duration, and stay put and overlook the short-term volatility. So two things would happen. A, your accruals are much higher because obviously the yield curve is flat today. One can say that even the short-term, the accruals are higher. Your accruals are higher, say 7.5. But when the rate cut actually starts to happen, because of the duration, the mark-to-market gains will be much higher. So
Okay.
that is the best strategy to do now. Buy a little longer and stay put.
Do you see either chance of US going for either hike of 25 bips in this year?
See, right now, based on the future prices, markets are not building any rate hike. In fact, 86% are saying hold, but we never know. Based on today's US CPI data point, expected to be around 3.3%. If it is extremely adverse, or if the core inflation is extremely adverse, one can think that they may do one more rate hike. But what we believe is that the various data points which are coming from the US in terms of the consumptions and the credit, and the recent downgrade by Moody's of various mid and small size banks tells us that the US Fed may remain on hold for a long period, because the downgrade definitely tells us that there is stress in the economy.
Will there be any impact of the risk of China entering into a stagflation? There is a chance of China getting into a stagflation. Will there be any global risk because of that?
I don't see there is any stagflation in China as of now, because there is a deflation rather. So
Correct.
they are growing definitely faster than what is their price increase. So it is a very, very difficult question, because Chinese government is pushing through various loose monetary policy measures. So we expect that the economy would hold up. Yes, they may be not as strong as they used to be, or the growth may be there, but yes, still much better. So stagflation is still, I would say that I'm not looking at stagflation in China, but yes, deflation is definitely there.
Just one sec. Let me just check if there are further questions. Any idea on Parijat, that is a question on what can be the fiscal deficit number for FY 23-24 and how it will impact on GSEC?
As of now, whatever is the budgeted number, which is at 5.9, so we believe that the government would hit that number.
Okay.
So the GSEC yield curve or the demand supply for GSEC will definitely depend upon how our growth and inflation numbers pan out.
So you don't see fiscal deficit number going beyond the budgeted number, is that correct?
No.
Okay. With that, we have covered all the questions. Parijat, thank you for taking out time for this.
Thank you.